Let's bring in Carey, Bank of America Securities, joining us now. How would you vote in our Twitter poll? Have we seen the best of the market for the year already?
Well, I think we were expecting coming into the year we could see a bit of a bounce given just how negative sentiment had been at the end of last year and, sort of the growing consensus view that it would be first half down, second half up. Now the recession timing has been pushed out. Our year-end target on the S&P 500 is 4,000. So, obviously not too far from where we are today. We think there is more potential downside risk. A lot of the, signposts we look at in terms of, what could signal a potential bottom in the market, haven't been hit yet. So, we think this is going to be, potentially volatile period for the market and that there's, better opportunities in spots of the market, whether it be small caps, whether it be sectors, whether it be, being an active manager and picking stocks rather than just owning the S&P 500 this year.
How would you explain the disparity, though, between your S&P target, which is more or less where we are, for argument's sake, let's just call it that, and the fact that you look for a really big decline, though, in earnings? You're at $200. That's pretty weak, all things considered.
Well, I think, look, it's half the magnitude of the typical recessionary earnings decline. So we are expecting a mild recession to begin in the second half of this year and last into early next year. Usually S&P earnings decline about 20% during an average recession. Obviously, they've declined more during some of the more severe ones. So this would be less than half of that. Obviously, there's been strength in the data, but when we look at what happened this earnings season, earnings have generally been in line to a slight miss, and that was even after earnings were cut substantially. Guidance has been weak. A lot of the measures that we look at of mentions on earnings calls have suggested some weak demand. So, we do think there's more downside risk to earnings forecasts at this point, but we're not looking for, as dramatic as what you usually see during a recession for the earnings decline.
So are you looking to play more defense here than offense? And let me just note before you answer the question, too, we are sliding a bit as we head towards the close. Dow is down by more than 400, 1.25%. Mentioned the NASDAQ is now down a cool 2% as some of those mega cap names drag things lower. So how would you play things, offense versus defense, and if defense, where?
Well, I think, we're not necessarily overweight all of the defensive sectors and areas. I think, when you look at what's priced in already, how positioning is, you get some different results than, maybe the typical recessionary playbook. Also, when you look at kind of the shifting risk profiles of sectors, some of the traditionally safer low beta sectors have actually become higher beta and vice versa. So we're overweight some of the more cyclical sectors right now: energy, materials, financials, and then we're overweight staples as sort of our preferred, high quality defensive sector. But we think a lot of these areas, energy, materials, sort of your old economy sectors, there was massive underinvestment for a decade. Companies that were more in the new economy, tech, benefited from zero interest rate policy, globalization. So, we think there's some longer term shifts that are going on where we could see a change in leadership. And then, small caps are another area that, have been really the only area pricing in a lot of the macro risks. And, we see as better positioned even amidst the recession risk right now.
Why are you underweight consumer discretionary? I mean, the consumer's been strong. That space was leading. Why you make that call here? It is up 10%. It is the best performing sector of this year to date, up near 11%.
Yeah, I mean, usually consumer discretionary is a typical early cycle sector. So at this point, if we're still expecting several more Fed hikes, typically you don't want to own the sector until the Fed is done hiking and you're into more of that early cycle phase. Consumer discretionary is also, the most labor intensive sector. If we continue to see wage pressures, it's the area where we see the most downside risk to earnings estimates. It's still generally crowded and expensive by active managers. So, that's an area that obviously some of the data, the consumer has generally held up well, but we do see risk to companies' earnings and think it's a bit early.
Jill, I appreciate it. Carey, joining us from Bank of America Securities. We'll see you soon.